Macroeconomic forecasting requires a stable baseline, predictable assumptions about trade, prices, and policy. But in July 2026, developing Asia's baseline fractured. The Asian Development Bank was forced to revise its economic outlook, pulling the region's 2026 GDP growth forecast down to 4.9%. Looking at the data, the downgrade is twofold. Alongside that 0.6 percentage point drop in growth, regional inflation forecasts were aggressively revised upward, spiking 1.3 percentage points above the 2025 numbers to reach 4.3%. These figures represent a chronic structural drag acting on the region's economy. To understand the downgrade, we have to break that drag down into three distinct vectors converging on the continent: energy market disruptions, rapid monetary tightening, and deepening fiscal exhaustion. We are going to track exactly how a localized geopolitical conflict transmitted through the global economy to force these sweeping forecast downgrades. Analyzing this shift requires following the shock from physical logistics choke points through to the abstract financial mechanisms that follow. Mapping this economic chain is the only way to determine if the region's current fragility is a temporary blip or a permanent new reality. The origin of this macroeconomic shock lies thousands of miles away from Asian markets, specifically within the maritime trade routes of the Middle East. Tracking Strait of Hormuz tanker transits, daily traffic remains severely depressed below pre-conflict levels, despite a mid-June agreement. This disruption forced a structural spike in global freight rates. Baltic Exchange tanker indexes show extreme volatility, hovering at elevations unseen since 2022. Initial predictions assumed these energy market disruptions would gradually unwind over the summer. They have not. Instead, the market is actively pricing in a higher, permanent cost floor for maritime logistics. A localized maritime choke point acts as a mandatory, unhedgeable tax on all regional imports. This is the first link in the macroeconomic shock chain. That bottleneck in the Middle East quickly cascaded outward, resulting in the rapid degradation of the entire global supply chain. You can quantify this stress by comparing two metrics: the plunging index of global manufacturing delivery times set against the surging volume of stalled shipping capacity, measured in 20-foot equivalent units. The transmission mechanism here is straightforward. Extended delivery times force up input and transport costs, broadening what began as an isolated energy price shock into general manufacturing. Looking at this chart of inflation contributions for developing Asia, you can see exactly where that 4.3% forecast comes from. Notice the specific, sustained expansions in the core, food, and energy-related bands from January 2025 through May 2026. Outside of the People's Republic of China, food price escalation is acting as the primary domestic catalyst driving this inflation spike. Physical logistics bottlenecks have mutated into systemic, domestic pricing pressure, affecting every tier of the regional consumer base. This entrenched imported inflation forces regional central banks into a difficult reactionary position. To gauge monetary policy, economists look at real policy rates, the nominal rate set by a central bank minus expected inflation. When inflation expectations rise rapidly, they actively suppress the true cost of borrowing, even if central banks are hiking their nominal rates. This chart breaks down those rate changes for 2026. Across developing Asia, we see a widespread collapse in real policy rates because the aggressive inflation forecast revisions, shown here in the negative effect bars, entirely swallow the nominal policy rate hikes. As a direct consequence, 10 out of 17 inflation-targeting economies in the region are currently operating completely outside their mandated upper target bounds. Capital flight is causing regional currencies to depreciate heavily against the US dollar across multiple subregions. Simultaneously, 10-year government bond yields are spiking. This massive increase in basis points reflects rising domestic risk premia as investors demand higher returns to hold regional debt. Regional central banks are now effectively trapped. They are forced to choose between importing further inflation by letting their currencies weaken or choking domestic economic growth with aggressive rate hikes. Despite these tightening monetary and logistical conditions, first-quarter regional GDP growth appeared unexpectedly firm. The headline growth data is masking a severe internal bifurcation within the region's economy. This chart of nominal export growth reveals the impact of external investment in artificial intelligence. Comparing Q1 2026 against 2025, specific technology exporting economies experienced massive growth in electronics and machinery, while all other sectors stagnated. Contrast this targeted tech boom against the lagging, often negative export growth in non-tech nations like Indonesia or Turkey, and the divide becomes clear. This AI surge is acting as an asymmetrical shock absorber, artificially inflating the overall regional average. Relying on highly concentrated AI-driven export anomalies creates a false sense of regional economic resilience, hiding the systemic macro weakness spreading through the rest of the market. The complete transmission path is now mapped. A disruption in shipping lanes drove core inflation spikes, which triggered severe monetary tightening. That brings us to the ultimate casualty of this macroeconomic shock chain, the exhaustion of regional fiscal policy space. This chart visualizes primary balances as a percentage of GDP. Looking across developing Asian economies, we anticipate a widespread structural deterioration, with sharp negative shifts projected for 2026 compared to 2025 estimates. This structural deterioration is driven from both ends. Governments face higher public expenditures while dealing with suppressed tax revenues. These governments must manage this deterioration while carrying interest burdens structurally higher than 2019 levels, resulting in severe spikes in debt servicing costs. These financial strains are compounded by secondary supply shocks. For example, the proxy energy shock directly raises the cost of agricultural inputs like fertilizer. These secondary agricultural shocks threaten regional food security, a dynamic that would loop back and drive core inflation even higher. Right now, developing Asia exists in a highly fragile equilibrium, narrowly propped up by resilient domestic demand and a concentrated boom in tech exports. Until the localized structural energy and logistics shocks actually unwind, the macroeconomic scaffolding of the entire Asian region will remain under severe, unsustainable stress.